Hi, I'm Maurice Crespi, Schindler's Attorneys. We have Ian Fleming on the panel from Engaged Business Turnaround, Peter Gordon, also from Engaged, Artisha from IQ Business Group, Lisa Marie Ahassi from IQ Business Group, from Schindler's, also a partner of mine, and Francois from the IQ Business Group. We're going to just allow participants to join. Let's see, we have 15 already. Just whilst we wait, just want to mention that we have scheduled a webinar for next week, which is a large group webinar. It's next week, Tuesday, where we're dealing specifically with the hospitality industry, and we with an emphasis on restaurants. And we're going to have economists on the panel, advocates, and business rescue practitioners who are in the restaurant business. We've had countless restaurant businesses be referred to COBRA, and we're dealing with quite a few. So we've got some important insights which we'll share with you on Tuesday. So please register for that. It's going to be quite an important one. Okay, so let's kick off. I think we've got our participants. I'm going to kick off with you, Peter, just to take us through business rescue in general.
Thank you, Maurice. Morning, everybody. Business rescue, it was promulgated in 2011. It's in the 2008 Companies Act, Chapter 6. It allows a company to file for business rescue, either by the directors choosing to do so, or the courts can put the company into rescue if one of the creditors or the shareholders, or what we call affected parties, applies to court to have the company put into business rescue. It applies to companies and CCs. It's a very simple process. The directors take a resolution on the basis that the company is financially distressed, defined in Chapter 6 as the company is reasonably unlikely to be able to pay its debts as and when they fall due over the next 6 months, or the directors believe the company is going to land up in an insolvent position in the next 6 months, i.e. Liabilities exceed assets as fairly valued on the balance sheet. Once in rescue, there's a steel blanket around the company. Nobody can bring any legal action against the company. And that is the main point of going into rescue, so that you're protected from challenges from specifically creditors demanding payment. During the process, a business rescue practitioner has to be appointed. All the matters that take place are driven by Chapter 6 and are time driven. The business rescue practitioner then takes absolute control of the board. Ian and I have a policy of always working in collaboration with the board. There's no point in being acrimonious with management who know far more about the business than we do. So it's a collaborative approach. However, if we find there has been fraud or something of that nature where we cannot trust the board, then obviously we're obligated to run the company on our own to try and sort it out. All labor law applies during rescue, so the rights of employees aren't affected at all. The business rescue practitioner is obliged to put a plan forward. The plan has to be voted on, once again under time limits. The creditors have a vote on the plan. The shareholders have a vote on the plan only if their rights are changed. So if you change from ordinary shares to preference shares, for example, then the shareholders would have a vote on the plan. In order to get a plan through, the practitioner must have a 75% of people voting, either in person or by proxy, vote positively for the plan. And then intriguingly, of that 75% vote, a percentage has to be classed as independent. Non-independent would be your classic shareholders' loans, directors' loans, fellow subsidiaries or intercompany loan accounts, etc. They have a diluted vote, and essentially of your 75%, 50% of the creditors who did vote have to be independent. So once it's voted through, it then becomes sacrosanct. It's almost like the MOR of a company. It dictates how the company is going to operate during the period whilst under rescue. And what the practitioner is then obligated to do is implement the plan. The important point to note, though, is that this is business as usual. There's no change in the way the company is going to do business, other than that the practitioner, together with directors, is trying to panel beat the company so that it becomes profitable. And that might be through cancelling contracts, renegotiating contracts, trying to get the gross margins up, trying to get the costs down. It's not just, I have to underline this, it's not just a matter of cost-cutting exercise. We do try and think out of the box and be creative. If it's a complicated industry of which we know little as practitioners, we do have the right to pull in consultants and experts to assist. And we have a fairly extensive network of such people that help us with rescues. I don't know, Ian, Maurice, if I missed anything out, I think that's
I think that's great. And I think what's nice about your introduction is you've covered business rescue in general, which hopefully will have led to some questions by the audience. So if there's anything that you've thought of that, or you'd like us to go into greater detail that Peter mentioned, please put it on the group. You can write to the panelists, or you can put it in the Q&A session. You can even put it up there anonymously. Peter, I'm going to take you and Ian a bit by surprise, because you're not aware of this, and I'm not certain what your answer will be. But yesterday, when it came to looking at onboarding, we had a company wanting to have COBRA assist its suppliers. So in other words, the creditor of those companies actually wanted us to assist. So we'll be onboarding several hundred small businesses. But the question that was posed is, practically every single one of those businesses, in their mind, would not be tax compliant. So the situation that will arise, and questions have been asked, is how does one deal with that? Because they desperately need to go into business rescue. However, they're not compliant. They have 2 cash books, let's say, and now they've got to consider business rescue. Now, what I'm going to do is I'm going to tell you what my response was, and maybe you can comment on it. What I said is, look, COBRA is there to avoid business rescue in the first place. So hopefully, there won't be a requirement to appoint a business rescue practitioner. But having said that, the moment a business rescue practitioner is appointed, the business rescue practitioner becomes an officer of the court and does have those duties that you just made mention of. So now, practically, we need to find a solution here, because the reporting obligation is a real one, but the reporting obligation only arises upon a business rescue. So it's important, I think, to encourage businesses to come pre-rescue to avoid that obligation from arising. I just want you to comment on that, because it kind of feels wrong to be advising businesses to come, but to avoid a reporting obligation. How do you guys deal with that?
Maurice, look at Ian, shall I go?
Yes, Peter, please go ahead. Thanks.
Sure. This is not an unusual circumstances in the SMMEs. And I mean, I don't know which potential clients you're talking about, but essentially one's got to acknowledge that, and let's all be clear with each other, when your back's to the wall and you can't pay your suppliers, you can't pay the VAT man, you can't pay the tax man, you can't pay your staff, and you've got a little bit of cash in, and you decide, well, if I get a little bit more on the supply side, and if I keep my people working, I can survive. So of course you do, and you don't pay the tax. So it's not an unusual situation to find even large to medium-sized companies who are in default with their tax obligations. Now remember, SARS gets very excited about that, because as a company, you're acting as an agent. So essentially you're deducting money from employees' salaries, you're adding money to your VAT invoices, and you're acting as agent on behalf of SARS to pay that over. So hence SARS, I suppose rightly so, get very excited, and it's in the law that you have to pay them. Now, in that particular instance, what we would do is immediately contact SARS. It's a very early question that we always ask in rescue because it is a very clear sign of financial distress. There's very few companies that are going to not pay a supplier, but rather pay SARS, unfortunately. But that's the reality of the situation. So if a company is in default with SARS, what we would do is approach SARS immediately. I'm talking about in rescue here. Advise them of the situation, acknowledge that these penalties and interest to pay, and capture them in the rescue so they'd be treated alongside any other creditor in the rescue, bearing in mind that on the day of rescue, all your creditors are frozen, and that's including SARS. Going forward, obviously the practitioner, if he's an above board practitioner, and one's got to be cautious that he is, then he or she, then it's important to make sure that you keep a communication line open with SARS as to what's happening. And if you aren't in rescue and not going to be able to pay any particular tax at a time, then just communicate with them. We communicate with them and get them on board. And generally, SARS are quite cooperative with those rescue practitioners that are playing by the rules and above board. If, on the other hand, we've got, your double set of books type scenario, that is a matter of, if the company's in rescue, obviously you have rights and you're obligated to investigate and insist that it's rectified and reported to authority, and one can do that. Now, that's a sort of headed into the gray area. If, on the other hand, you are dealing with a plethora of small businesses that are just not paying tax and are not registered for tax, and you're not in rescue, there's nothing to stop a person advising that individual or that small company on how to go about managing their business and saving cash, and in that process advise them how to rectify their tax affairs. It's no point in being heavy-handed. If you've got somebody that hasn't been compliant and you be heavy-handed, well, first of all, they're not going to come back to you because you have no legal obligation to come back to the individual. He's not your business rescue practitioner. So it would be pertinent to give them the correct advice, state what the law states, but then equally be practical about it and say, look, this is how we can overcome the problem, and this is what's got to happen. Now, I'm assuming, of course, that the person in that scenario is going to comply. Marisa, unfortunately, I've had situations where people say, well, thank you very much for that, and I never hear from them again because they're wishing to remain outside the law, outside the tax net. But I mean, it's a slowly process of explaining. As I say, heavy-handed has never worked. I, at one time of my life, ran a mentorship program for one of the large banks in the small SMME space. And a lot of the guys were not complying. And, the instruction that I gave to all the mentors that I had around the country is just work with rather than against the individuals and slowly get them on board. If it eventually becomes so uncomfortable that one believes that this is now an ongoing illegal action, then I'm afraid you've just got to say, look, thanks very much, but no longer going to be a client of mine.
I just mentioned, and as an aside, out of interest, I was just thinking about it in terms of Section 34 of the Prevention of Corrupt Activities Act. You also have a duty to report. Every single individual has a duty to report if they are witness to an offence such as fraud, which exceeds 100,000 rands, and they're in a position of authority. So that obligation, again, would only arise in terms of Section 34 once you're appointed as a business rescue practitioner, but not before. We have some questions. Guy has asked, what is business rescue? Why is business rescue? Yeah.
Sorry, Maurice, to interrupt. Just very briefly in that, it all depends on the engagements that you have with the client. I mean, I've had because, we run a corporate finance business in addition to business rescue. So I have had situations where you come upon something, you are appointed to do a sale of a business, a capital raise on the business, evaluation. Guys want their companies valued, and they say, but by the way, here are the real figures. Don't ignore what the tax man did, received, etc. It is important in that scenario to make sure that you comply with the regulatory authority to have to report. But make a strong case to the company that you're shooting yourself in the foot by doing this, because when it comes to selling a company, that's when all this normally comes out. And it's important for companies to realize that to play above board means that at any point where you're wanting to get finance, where you're wanting to sell, where you're wanting to do anything that requires somebody to understand the full impact of your business, then it's far easier to have a set of accurate figures. Sorry, I interrupted.
If I could just add to that, Peter, just from a very practical perspective, where small businesses are concerned, SARS are very seldom a very big challenge for us in business rescue. I say that because they're actually quite reasonable. They're fairly good at attending meetings and so on, and they are never the creditor who is screaming for the liquidation of the company. SARS, you will very, very seldom find a liquidation application coming from SARS. So, so our experience with SARS has been pretty good in business rescue, especially with smaller businesses. And just to be perfectly honest, SARS is more interested in chasing tax debts of large businesses than with small businesses, which I think makes it fairly reasonable to negotiate with in small businesses.
Yeah, and just to mention, as part of the consortium, Schindler's Attorneys is a consortium partner. They have a tax department that is very much part of the COBRA initiative. So tax advice is there. And bear in mind, this is pro bono. All you need to do is let us know, and we'll set up a private meeting with you and your team, and we can just talk through these issues. There's a question which I'll address, if I can pull it up. There we go. Why is business rescue so complex and onerous, and therefore often done too late? So Guy, in my experience, the reason it's done too late is because of the stigma associated with it. There's not only that, but many agreements, and Peter would know this, in terms of the agreements, there are provisions dealing with default, but also forced sales, let's say, of shares in circumstances where there's an application even for insolvency or business rescue. So people do not want to go into business rescue, particularly when they are heavily geared, because loans get called in. Business rescue is a trigger event. The stigma in our minds has gone, because this is all as a result of COVID. It's not as though we have businesses who were dishonest or they were foolish. Everybody's in the same boat. And whilst I'm on the topic, in terms of section 129 sub 7 of the Companies Act, a company is obliged, the directors are obliged to put a business, to put business rescue to the vote at a board level if the company believes, or the board believes, that the company is financially distressed. What is meant by financial distress is if there's a reasonable likelihood that the company will not be able to pay its debts as and when they fall due. So the test is not high, and most companies in South Africa fall within the definition of financial distress. So it has to go to the vote. If it goes to the vote, the directors, if they vote against business rescue, they're obliged in terms of the provision to send a notice to all creditors and employees setting out why it hasn't been put to the vote. So what reason can one give to creditors or to employees? Simple reason is you're in the COBRA ecosystem, and the COBRA ecosystem is designed to avoid a business rescue. The COBRA ecosystem is designed to have our mediators strike arrangements between your creditors. And in turn, what we do is we encourage those creditors to come into the ecosystem, and then we deal with them. So all the way from the spaza shop, we go up the ladder, all the way up to eventually the banks. What we've had yesterday, and we mentioned it, is in fact now we're also having the guys right on top, at the top of the supply chain, saying, help the guys below out. So COBRA is quite important for that. So why is it done late? It's because people do not realize that they're obliged to put it to the vote when it's financially distressed. People do not know the law. When directors are told that, they're often surprised. And secondly, there's the stigma and the trigger events. I'll ask you, Peter, you're in corporate finance as well. You know, I mentioned these trigger events, and you've seen it. I mean, most agreements, when it comes to that kind of funding and that kind of structuring, do have those provisions. They do have those trigger events.
And Maurice, absolutely. And in fact, you know, this is a multiple question that's been asked by Guy, because your larger groups of companies, you know, believe me, the day that Group 5 went into rescue, there were numerous agreements that were triggered. Now, what those trigger agreements are, it's normally the classic default clause. The banks were a little bit slow in getting off the starting blocks when Business Rescue first came on board, so it didn't include, generally agreements didn't include Business Rescue as being a default. It would include any sort of application for liquidation or declaration of insolvency by the company. They now 99.9% would include, unless it's a very old agreement and the banks haven't updated or forgotten to update it. It is a point that we would check. But that default will trigger the default in terms of that loan agreement, in which case the loan becomes immediately repayable. And when we're talking about loan agreements, also be cautious, because people often think, well, you know, I've got an overdraft facility. The challenge with an overdraft facility, it's not in a agreement for term, it's issued under a facility agreement. And if you check your facility agreements, it will always say that if there's a default, this facility is payable immediately. So just be cautious of that on overdrafts. You sort of think you've got a 100,000 Rand facility, and you go and do something that is a declaration of insolvency, it will trigger that default. The one good thing, of course, is in Business Rescue, the bank can't then claw back its entire overdraft. So if you're a 100,000 facility and you're up at 99.9, it stays at that figure. But then most importantly, we would get into the banks as quickly as possible to negotiate with them, because obviously without a bank, let alone an overdraft facility, one cannot operate. How do you pay your staff, suppliers, et cetera, et cetera? So that's an important point. Maurice, the other thing with, just to pick up on Guy's question, my experience is a lot of companies, the directors are running scared. They know the company is not able to pay. They have been threatened by the landlord, by a supplier, by a shareholder, whoever, and they're not too sure how they're going to cope with this. And then they get told by one of their mates around the pub one night that, well, you must be careful, because if you're trading recklessly, you're going to pick up a personal liability. Now, that's Section 22 of the Companies Act, and absolutely right. If a director trades recklessly, i.e. takes on additional liabilities on a company, and this is directors and senior managers importantly, then those individuals, if the company fails and goes into liquidation, can be held personally liable for those debts. Often it's triggered by fraud and something of that nature, so underhand transactions, but there is that risk. Now, Business Rescue takes that risk away immediately, because the directors, as Maurice has rightly said, are obligated to put this to the vote. They vote such, they go into protection, and it immediately gets rid of the reckless trading concerns. Obviously, there can still be a challenge from a supplier who's got personal sureties from the directors. They can still take action against the director or shareholders if sureties have been given. Important is to check the wording of the surety. But back then to Guy's question, why is it so complicated? Believe me, of all the chapters of the Companies Act, if you're dealing in the takeover and regulations panel regulations, the JSE, boy oh boy is it complicated. You can contravene the JSE rules so easily, and the takeover and regulations panel is quite horrendous what you have to do. Business Rescue is a resolution, a sworn affidavit, a form signed, filed, that means sent by email to come to subsede. It takes you 5 minutes, you're in rescue. Obviously, and as I said earlier, the practitioner, not all of the practitioners, and it is an important point to make sure you're appointing the right person, is that we're working with the company, business as usual, but with protection.
I was just going to say, Peter, I was going to echo those exact sentiments. It's the guys. I mean, we know guys who are intricately involved in the writing of Chapter 6, and they've actually made it. One of their aims was to keep it as simple as possible, especially where small to medium-sized businesses are concerned. They've made it really easy to put it into Business Rescue, and Chapter 6 of the Companies Act is a fairly small part of the Act, and it only takes up a few pages, and yet it still covers everything that needs to be covered. But keeping it simple was definitely a priority when writing it, and I think they achieved it to a very good extent. Obviously, it becomes complicated when there's so many different nuances in more complex businesses and so on. But yeah, it is actually, like Peter said, not a very complicated piece of legislation on the face of it.
Yeah, Ian, something I've just thought of as we're talking. I mean, it's an intriguing thought. The entire Companies Act is a dictate of how a company has to operate, other than Chapter 6. It is there to protect the company. Most of the clauses, I'm not a lawyer, Maurice, you might comment, but are there to tell you what you have to do. And this is there to say how you can protect yourself against people who might want to do you damage. So it is the only totally protective section of the Companies Act.
Yeah, 100%. So I just want to make one further comment whilst we're on the topic. You mentioned that we were talking trigger events and the fact that banks could call up a loan, and what's important there is just to discuss the moratorium. The moment you go into business rescue, the banks will not be able to sue you on that accelerated loan. So whilst there's an acceleration clause and the trigger has taken place and the acceleration has taken place, there's nothing the bank can do about that. But having said that, why you need an experienced business rescue practitioner is because there are nuances to that. And one of them relates to contracts. The moment a business rescue practitioner is appointed, that business rescue practitioner ought to write to all counterparties to any agreement between the company and a supplier to suspend the contract. So for a contract to cease running, the business rescue practitioner must send a notice suspending the contract. If the business rescue practitioner does not do that, the counterparty to the contract can still place you in breach and can still cancel the contract. If that takes place, let's say in the case of a lease, you'll find that an eviction, and there's a judgment by Barachovitz to this effect, Judge Barachovitz, that an eviction is appropriate even if the company is in business rescue. So inexperienced business rescue practitioners won't know this. What you need to do if you're not going to be utilizing the COBRA system is ensure that you provide a list of all your creditors to the business rescue practitioner and highlight the contracts that you're bound by, so the business rescue practitioner can write to the counterparties and suspend those agreements. I also want to mention, and this is well, let me first deal with Mandy. Mandy's asked, are you able to comment on the Rupert Fund applications? If so, my question is that I applied online and subsequently received a letter of rejection. The explanation being unable to verify company viability. A short while later, I received another email with the difference reference, which requested documents to be submitted. Any ideas? Firstly, I'd just like to make the comment that we're experiencing at COBRA, because of the scalability and we're still implementing these systems, there are teething problems, and this may be a teething problem. Secondly, to actually deal with the question, we normally have Dean Wright, my partner, who is dealing with the applications, and he would be better placed to have answered that. But as part of COBRA, we are setting up a dedicated person to deal with these applications. So let us look into it for you. We'll take it up. Send us the emails. You can write to COBRA. It's info@cobra.gov.za. Let us put you into the COBRA ecosystem and let's find out what's going on. It sounds like a system glitch. I want to move on to a very important point. It's one of the takeaways that we ask our audience to make an important note of, and that is we're experiencing, when businesses come to us, often what they've done is, often the shareholders have put additional money into the business to keep it afloat. So the shareholders are of the view, well, they've got to pay salaries, as an example. It's unfair on the staff that they not be paid, and you may find that a director, a benevolent director, will fork out the cash to cover the staff salaries. Now, there's what's known as post-commencement finance. That's dealt with in Chapter 6, and post-commencement finance gives the lender super preference over the loan, which means that the lender is in a better position, ranks higher to even, let's say, the South African Revenue Services when it comes to being repaid. So if you're going to be putting money into the business, it's a no-brainer. Put the money in post-business rescue so you get that preference. So I'm going to ask Ian to just expand on that. Ian?
Yes, thank you, Maurice. So if a business is going to go into rescue, it's better to put the money in after it's gone into rescue. The reason is that post-commencement finance, as Maurice correctly said, ranks right at the top in business rescue, just below business rescue for practitioner fees and remuneration and disbursements when it comes to repayment. And we call it the waterfall of repayment. So when it comes to repaying the loan, if the company is still in business rescue, then post-commencement finance will rank right up there. If the company subsequently, for whatever reason, heaven forbid, goes into liquidation, then if that post-commencement finance is secured by an asset in the company, then the repayment of that post-commencement finance ranks right at the top. That's when business rescue fees and disbursements fall to the bottom when a company goes into liquidation, but secured post-commencement finance ranks right at the top in a liquidation scenario. So if you want to try and give yourself the best possibility of recovering your money, and you're putting it in, when you're putting it into the company, do it when it's in business rescue and secure that loan via an asset in the company.
Yeah, in fact, I've dealt with commercial transactions where we've in fact put the company into business rescue and out just to get that super preference, and it also sanitizes the company to a certain extent once the plan is voted on. The liabilities are compromised and the company is better off. On directors, again, whilst I've got you in, the dynamic, I mean, I know the law in relation to directors, they still remain, as Peter actually briefly mentioned, they still owe the duties to the company, the fiduciary duties to the company. They still can be declared delinquent. They have those duties, but now these directors were the captain of the ship, and you come in. Yeah. What are their duties towards you?
The duties of the directors towards the business rescue practitioner are ultimately that the directors report to the business rescue practitioner, or the business rescue practitioner has ultimate control over the board and what the business rescue practitioner instructs or asks the directors to do. Their duty bound to do it in addition to all the normal fiduciary duties. So hence the reason why we always say that the choice of the business rescue practitioner is so important, because of the power that he wields. So you need somebody who can come in and work with you and work responsibly with you, not somebody who's going to try and take over and sort of reinvent everything and try and run the company in the way that he sees fit. We always say that we will never know, when we come in as business rescue practitioners, we will never know the intricacies of your business like you know it, because you've been running it for however many years. We will never have the relationships with suppliers, the relationship with customers, the relationship with the public, broadly, that you have. So therefore, we are there to get involved, to help you through the financial distress, to hopefully get you out on the other side, to hold your hand through that process. And because we're a multidisciplinary practice, we are also there, and our skills, our multi-set of skills that we have within the COBRA environment are there to be able to plug the gaps that might exist within your business and which might have contributed to your financial distress.
Yeah, I mean, business rescue in effect introduces a whole new skill set that the directors can tap into, because unlike with the liquidation, business rescue is a team effort, and it's important that it remains a team effort, even though there's effectively a statutory employment type relationship between the directors and the business rescue practitioner. Whilst we are on the question of duties, another important aspect of business rescue, what's often asked, is the situation apropos employees. And on that score, like directors, the provisions in relation to their duties remaining extinct, the same applies to the rights of employees. The rights of employees are covered in the Labour Relations Act. They remain entirely in place. And importantly, Section 189 of the Labour Relations Act deals with dismissals based on operational requirements. And in terms of that section, you're duty bound to consult with the employees on any variations, proposed variations to an employment contract. One does that to avoid possible dismissals. It's often a proposal to avoid, particularly in this case, the dismissals, to consult on the timing of the dismissals and what have you. So you still have that duty. You cannot simply say to the employees, listen, you are not being paid, or we can't afford to pay you, in circumstances where they're able to tender services. So they're working from home, you're duty bound to pay them unless you get the agreement to a reduction, or unless you go through a retrenchment process, and as an alternative, you offer them a reduction. If they say no, you then have to retrench. Problem there is, do you have the money to pay the severance? The severance pay that will accrue. And that's something we'll ask Peter to comment on, and how that's dealt with. But importantly, deal with the employees on the basis that they, if you're going to get an agreement from them, make it a variable agreement as to fixed, because what we're seeing is that companies are agreeing to 25% reduction. That seems to be the common one. But what about next month? What about if the restaurant game, as an example, and this carries on for 6 months? That's not going to be good enough. So one model, for instance, is to agree with the employees that whatever cash comes in, you'll pay them pro rata their salary bill. Then that renders it variable, and you know that you'll survive. Similar to what you try and do with a landlord. Peter, do you have a comment?
Maurice, yeah, look, I mean, and you make a very valid point there, because what you're trying to do in business rescue is, well, first of all, conserve whatever little cash you have. And then importantly, and I'm talking in a situation where post-commencement finance isn't readily available, which is often the case, certainly in this SMME market, is you're trying to conserve cash. And if you can turn, and I think Ian covered this yesterday, if you can convert any of your fixed costs into variable costs, which is what, Maurice, you're now saying, you're making salary variable related to turnover. So same as your cost of product is a variable cost. If you don't sell, you don't have to incur that cost, whereas salaries isn't. It enables you to put some flexibility into salaries. The other trick on this, of course, is when you are doing the business rescue plan, it's quite critical that the practitioner gets to understand, most importantly, what the cash flow model looks like, which is obviously driven by sales and the profits and the balance sheet, etc. But in that cash flow, to understand where the peaks and troughs are going to be, so that if you are going through a 189 process on an accelerated basis, which you're allowed to do under rescue, is that you meet your obligations for the payout to suit the cash flows. However, and we've had this, if you can't, you then just got to say to staff, you know, it's a horrible thing to have to do, but, you know, unfortunately, we're going to have to wait. We can't pay you as we plan to pay you. And, you know, but importantly in that situation, I think in fairness to anybody that has no longer got employment, to at least say, you know, we're going to pay it out over the next 3 months or next 6 months or whatever else. Maurice, because I believe so heavily in synchronicity, as you were talking, I've just received an SMS of a message that went out to the Edgar's staff in Sandton City from the store manager, stating that the entire executive of Edgar's, now people might not be aware, but Edcon is not in rescue, but made an announcement that they weren't going to be able to pay anybody for February and March deliveries, and were uncertain about April, May, June. and that included staff. And they've just given an announcement that the entire executive have taken zero salary, and then on a decrease in scale up to store manager who's had to forego 50% of their salary. So that's an example with, you know, a massive staff complement working with management to try and make sure that, you know, the people that are at the lowest level of salary income are still protected. It's quite commendable.
I also got you on, Peter. I'm going to share my screen. We did this yesterday, and it's to take the audience through the voting to better understand how it works with reference to independent and non-independent shareholder loans and what have you. So I'm going to give you this example, same as yesterday. I'll put it up on the screen. It should be up. Can you tell us whether, now this is in relation to the voting on a plan. So a plan's been put together. Now the accreditors, shareholders, directors, they're all involved with this plan. The shareholders' loans at that point in time are 100 rands. Creditors 50 rands, but they vote no. The shareholders vote the shareholders of the loan in the capacity as lenders vote yes. The shareholding is 100% by those shareholders. They want to vote yes, and the directors want to vote yes on the plan. Does the plan go through?
No, Maurice, the plan fails. For the simple reason that in terms of the voting, remember I said earlier, 75% have to vote positively for the plan. And of that, of everybody voting, 50% have got to be independent. So the first test is independent creditors have to vote. They have they're number one control of the plan. And if 50 are the only people voting and they've said no, your plan fails. The shareholder loan votes in this case would be classed as dependent, but they have absolutely no say because their rights haven't been changed. And interestingly enough, you present the plan to the creditors first, and we often used to talk about it's a provisional adoption of the plan, because if the creditors say yes, you then still have to take it through the shareholders to get them to vote. But what's transpired is the law says unless their rights have been changed, they don't have a vote. So if the shareholders' rights in this case have been changed, they would have a vote, but unfortunately the plans failed at the first hurdle, which is creditors. Directors do not vote on the plan, and you know that's directors as directors. Important for directors, very often in a small, medium company, directors are wearing numerous hats at a time. They never really think of this, but a director is an employee. They're an executive and affected by the Companies Act regarding their fiduciary duties. And they may well be, as often is the case, a shareholder. A shareholder has equity exposed to the business, which stands right at the back of the queue in any wind-up of the company, including rescue. But they may also have loans. So, you know, there's a shareholder as a creditor. Your director could be a creditor, an employee, and a director. Directors often say, you know, I'm just going to resign, but I'm going to continue working my employment contract with the company, and they're a senior manager in the company. Well, they're still affected by the Companies Act because the 2008 Act pulled all senior management into the fiduciary duties broadly, responsibilities, and affected senior management as well. But in this particular scenario, the plan is voted down.
What happens if the plan's approved, but the plan's a bad one and it just doesn't work?
Reese, look, what we do,
salvaged.
I mean, it's an important point, and I think a lot of practitioners realize this fairly quickly. Some, unfortunately, still haven't. Is when you draft your plan, you must have a clause in the plan which allows you to amend the plan to a degree, and it's important to state what that degree is. So if it's not a material change to the rights and obligation, basically the rights of the affected people, being creditors, staff, shareholders, loans, etc., then you don't have to go back to the vote. But if you're changing something quite dramatic in the plan, so we thought we were going to sell the business, but now we've decided to continue trading the business, And the shareholders, the creditors rather, voted positively because they thought that's great. They're going to sell this business and we should get paid out in the next few months. And now you're going to trade the business. Obviously, that affects the creditors quite significantly because trading it out might take you a number of years. So in that scenario, you would have to go back to the creditors for a vote on an amended plan. But generally, you don't want to be running back to creditors every 5 minutes to get approval to do anything, whilst they have the right to vote on the plan and therefore in control of the plan to a degree. It is up to the practitioner to be practical with management and run the business as best as possible. And, you know, business is not, the company's act is there to give guidance, but the business is not going to, I always say to people, you can give me a forecast of what your business is going to do. I can tell you one fact with 100% certainty, it's not going to be how you plan because things change. It's a dynamic process. So the business rescue plan is no different. It's dynamic. It's going to change as you go. We thought we were going to sell a property. Now we've decided to sell an entire subsidiary or division. You know, those are the sort of things that you decide on the day as you interact with the market. And when you find out where money can come from, and money in this process is absolutely king, you know, who's going to provide money? I mean, we were talking earlier about, you know, how to deal with SARS and how to pay. The number of times we've sat around the table and said, are we really using this bucky? Cannot we sell it? And we go on and we get hold of one of these online used car sales operations, sell it and put 250,000 in the bank account and pay the staff or pay the redundancies or pay the tax. So it is a matter of, you know, using whatever means you have, as is normally the case with business. But now we have the protection. And the one important thing with protection to remember is not only are you protected, but everybody that you owed money to is frozen. So that money that you were going to have to pay out, including your suppliers, is immediately frozen and thereby gives an immediate cash injection to working capital in a business.
Ian, you've had a scenario where the business plan has been good and you've known it's good, but it's been voted down by a creditor who's acting in bad faith. What can one do in that situation if you can prove to a court, let's say, that the creditor's got an ulterior motive?
We've had instances like that, Maurice, and it can be a case of a creditor voting in bad faith, or it can just be that one of the affected persons believes that the creditor's thinking is misguided, and so it's not necessarily bad faith. But the remedies that are available to affected persons is that, well, firstly, the business rescue practitioner should negotiate as to the best extent possible, opening the floor to affected persons and so on. You know, ask why. He needs to put the question forward to the opposing creditor as to why why they won't vote in favour of the plan, and how would they amend the plan in order to consider it to be a good plan and to vote on it. So that is the first step. The entire business rescue process is a big process of negotiation, and right through to the end, right through to the vote, and even beyond the vote, if the plan is not voted in. Should that creditor still refuse to vote in favour of the plan, then any affected person, or then the business rescue practitioner is obliged to put the company into liquidation. However, any affected person can then express their intention to go to court to have the vote set aside as inappropriate. And he can then the business rescue practitioner is absolved from having to put it into liquidation, and the affected person can then make application to court to have the vote of the creditor set aside as inappropriate. And should the court then find in favour of that affected person, then the business rescue plan will be allowed to be implemented.
We have a question by Jane. Morning, everyone. Many thanks again for your time and effort. Could you please give an indication of how long it takes to be recognized, integrated within the COBRA ecosystem? I'm concerned as our small business is already unable to meet its financial obligations and they sent an email, you sent an email yesterday, and you want an ethical, above board, as well organized with creditors and affected parties as possible. That's the intention. I'm going to follow up on that. As I said, the systems are well, they should be in place. We went through everything yesterday and last week. The idea is the moment you send an email, you should get a response and you should be in the ecosystem. So what I'm doing is I'm going to find out why your particular email hasn't been responded to, and we'll ensure that we get a response. If you still do not get a response, please email me personally, crespi@schindlers.co.za, and we'll see to it that you're in the ecosystem. And the idea is we'll speak to your creditors, tell them they're going to be saying, no, but we've got to pay rent, and then we'll say, okay, come into the ecosystem, we'll deal with your landlord, and we'll strike a balance there. Just around how COBRA works, I think it's important that we provide an explanation on the pro bono services that are offered. What's pro bono is regardless of a means test. So in pro bono, the Law Society, for instance, requires that we only provide pro bono services to those in need. And those in need, when it comes to individuals, the amount is, I think it still stands at 7,000 rands a month. So if you're below that, you qualify. In this case, we're dealing with corporates. So what we've done is what's pro bono outside of the means test is legal advice, accounting advice, setting up Zoom meetings, meeting with your staff, meeting with your creditors, mediating an arrangement. All of that is free. If you have to go into business rescue, the processing of the business rescue application, if you have to apply to these relief funds, we've got a dedicated person doing that. And then we have the webinars, we have the knowledge base and what have you. Then when it comes to the actual business rescue and the saving of a business, what we do there is the means test is the benefit of hindsight. If at the end of the day, professional fees are an impediment to a successful rescue, there will be no professional fees. If, however, you are left with millions in the bank account after the rescue, then there's going to be a chat with the professionals, because you got to strike a balance there because you didn't qualify for pro bono. If you enter the COBRA ecosystem now and your business does not get salvaged, i.e. the system has failed in salvaging your business, a high court application is required, which costs between 20, 30, up to 50,000 rands to convert the business rescue into a liquidation. If you came to the ecosystem, into the ecosystem up front, you gave us a shot. If we don't come right, we'll convert the business rescue into a liquidation at no cost. So Schindlers will be doing those applications. Hopefully there won't be many, but what we recognize is that if you've lost your business, if you lost your shares, the last thing that you can bear is a 30,000 rand attorney's bill. So that would be covered. We also have a letter which I wanted to call up, but I can't find now. It's a letter that you send to your creditors saying you've joined the ecosystem, you're not going into business rescue, and you invite them to join the ecosystem so arrangements can be put in place. So that's how it works. Please email us. If you have any questions, please post them now. If I've missed any questions, let us know. Are there any further comments by the panelists? Yeah, I think just to the audience, please reach out, get into the ecosystem. There's no downside in coming into the ecosystem. There's only an upside. We've put it together to help small businesses and to get them through this. So another important aspect, just to conclude, is what we're finding is there's also cross-pollination of services within the ecosystem. So once you're in and you provide a service, and let's say that service is required to save another business, well, you're in a space where you can actually get business from other companies in the ecosystem. So that's it for today. Remember that we have the webinar on Tuesday that's specific to hospitality. If you have any questions or you want a one-on-one so we can deal with your particular situation, please email us. We'll set it up. So I said, if you're not getting a response because the systems are down, email me privately. Great. Thank you, panelists. Thanks to the audience. Thanks for your time. We're not going to have a webinar tomorrow, and we're not going to have a webinar on Monday, but we'll have Tuesday and thereafter every weekday. There'll be an additional one. If you want to ask questions, hop into one of those. Thank you. Bye-bye.
Thank you.